We're just over a week into 2026. How are your New Year's resolutions coming? I admit my goal of turning my one pack into a six pack is already on shaky ground, unfortunately. And maybe you can relate when it comes to your finances. But don't sweat it. Unlike my fitness goals, help is on the way. We've got a savvy DIY investor here to share his top investing tips for the TFSA, RRSP, and FHSA to help you make this year a financial success. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise, and I'm really excited for today's episode. It's good to be back after the holiday break, and I want to say I think making early progress towards your financial goals in the new year can be so important to ultimately reaching them. It builds confidence, it motivates you, and I'm hoping that the tips that we share today can help you get some of those quick wins that can get the ball rolling in the right direction. So let's get into it. Joining us is Dan Kent, founder of Stocktrades. He's a DIY investor of over 15 years who runs one of Canada's most popular investing communities. Dan, it's wonderful to have you back on the show with us. Thanks for taking the time.
Yeah, thank you. It'll be fun.
I know it's
Thanks
busy.
for inviting me back.
Yeah, I know it's busy in the Dan Kent household here with new twins in the mix. So congratulations to you. I'm curious, what are your financial resolutions for this year?
So New Year's resolutions is actually related to the twins. Yes, I had twin boys back in October, and I mean, my main financial resolution would be to kind of try and max out their RRSPs, without while still contributing to my regular accounts. So I probably got to try to find $5,000 worth of extra room there. So it's going to be pretty tough. But other than that, just continue to make solid investments.
You're scraping together the RRSP money on top of saving for all your other goals too. It's not easy. I got a 19-month-old at home, so I went through the same thing. You got double trouble here. You got to come up with twice as much money, but good luck to you in that. That's a great resolution to have, and congrats again on the twins. Of course, for some investors, they're eagerly awaiting the turn of the calendar, the more diligent among us, because that's when the new contribution room for tax-free savings accounts and first home savings accounts come into play. I'm curious if there's anything in 2026 that you feel investors need to know about these accounts or any of the registered accounts that we're going to talk about.
Well, I mean, just for most of them, I guess just standard TFSA contribution room. We have 7,000 for 2026. I believe the FHSA is 8,000, and then obviously the RRSP is going to be very specific, I guess, to what you earn, but not really any huge changes for this year overall. They're just, just make sure. I would say one thing, check your contribution room before you start putting money in. One thing I do like to do myself is actually keep track of the TFSA contribution room myself if it's close to being maxed out, because a lot of the times, and even RSPs in that regard, because a lot of the times the CRA website is a little outdated, I guess you would say. And I've had the situation where some people end up over contributing because of this. So yeah, check that. But outside of that, it's just, par for the course for most of these accounts, just annual contribution room for the year.
Yeah, 2026, no major changes in terms of contribution room, so that makes things a little bit easier. But that's a great point on the CRA website. It does lag a little bit, so you always got to keep your own records. That's a great tip to keep things top of mind. With that said, though, let's get into some of your top investing tips for the TFSA, RRSP, and FHSA. Boy, that's a lot of acronyms. And for those in our audience who want to get in on the conversation, we want to have you too. Make sure you submit your questions to us. If you're watching on Webroker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, it's the questions and comments box. And if you're watching on our YouTube live stream, you can click on the link in the description. It's going to take you over to our broadcast platform, and you can ask your questions there. With that said, Dan, I want to start off with the TFSA, tax-free savings account. That's one of the most popular registered accounts. Can you just give us a quick refresher on how this account works at a high level?
Yeah, so every single year you get a set amount of contribution room, that carries forward indefinitely. So it doesn't matter whether, you have room from 10 years ago, it still carries through. What you do is you contribute to this account with after-tax dollars. Anything inside of the account ends up earning tax-free. So you're talking capital gains, you're talking interest, dividends, things like that. And then when you pull that money out, it is also tax-free. So you can think of the TFSA, you do not get a tax credit going into the account, but you also don't get you don't have to pay tax when you pull it out. And I do find this is probably the account, I guess you could say, that never really loses its luster as you get older. Like the TFSA, whether you're 18 or 81, I mean, you can contribute to it. You get your annual contribution room. You can earn inside that account tax free. Whereas a lot of the other registered accounts, I guess they kind of have like a lifespan to them where they become not as useful. I don't think the TFSA ever gets to that point.
Yeah, it's a really flexible account in a lot of ways, putting money in, taking money out, and that can make it a great fit for a lot of different investing goals that you might have. So it's often the go-to, I think, for a lot of investors. With that said, your first investing tip for the TFSA is to avoid holding speculative investments in this account. Tell us, how could that potentially backfire on an investor?
Yeah, so a lot of people, like when they first start with the TFSA, I guess the draw to buying more speculative stocks in this account is the fact that it is tax-free. If you buy a stock and it goes up by 10x, 20x, you won't pay any, you won't pay the government anything when you pull it out. But the unfortunate thing is you have a finite amount of TFSA contribution room. So if you lose that room, it's inevitably, gone forever. So a prime example, I had somebody, this was probably 10 years ago or so, they invested around $30,000. And I believe back then the max TFSA would have been around 60 if you had maxed it out. So they invested that $30,000 into a very, very speculative stock here in Canada. It was on the venture, and they ended up losing pretty much all of it. So the next year, all they ended up getting was, at that time, it was probably $5,000 a year in contribution room. So they lost that 30,000. They don't get it back. And if you're to think about how much that $30,000 would actually earn over the long term, it's actually a mistake that can end up costing you, hundreds of thousands of dollars. I mean, even if we make the assumption, and sorry, I'm reading off some numbers here that I crunched. If we assume we're 25 years old, by the time we're 60, that $30,000, if you were earning 8% a year, would have grown to $443,000 at an 8% return. So the market average. So, and that's tax-free money. So I think when you go super speculative in your TFSA, you're putting like one of the best tax advantage accounts and your money, a finite amount of money in it, at risk, and it can end up costing you over the long run.
Yeah, it's almost like you can't get greedy with it. You've got this great tool to use, so don't try to overextend it. But that said, of course, as you alluded to, investors, they don't want to be paying tax on their high growth investments. Are there certain types of investments that you feel, generally speaking, are just like too risky for TFSA? And if so, are there other accounts that are a better fit for those types of investments?
Yeah, I mean, I would call them like the moonshot type investments, like the highly speculative investments that you're kind of buying. You're either going broke on them or you're making a ton. I kind of like to call them, and a lot of people who follow me will understand this, but scratch off tickets, like that's kind of what I call them. Like you're going to lose on most of them. You're going to break even on a few, you'll win on very few. You're going to lose on most, break even on some. So you kind of want to avoid those in a TFSA. And I find, a lot of the times when I say, you shouldn't hold these growth options in a TFSA, I'm not necessarily talking about, like large scale growth companies. I'm more so talking about those speculative companies. Those should probably be reserved for a taxable account, because first off, you can write off the loss if you do lose it. It's a capital loss. In a TFSA, you can't do that. So in the situation of my friend there, that $30,000, if he had done that in a taxable account, he could, have a capital loss that he could put against future gains. Whereas in the TFSA, you just lose that money. You lose that forward contribution room, and you actually can't write it off any gains either.
Curious to get your thoughts on things like crypto ETFs, which more and more investors are kind of considering. Like, is there an account that makes sense for those? Because they're quite speculative in some sense.
Yeah, so I do own a Bitcoin ETF, and I do own it in my Lyra, my locked-in retirement account. So I do own it in a tax-sheltered account. A lot of people, I mean, if you're short-term speculating on crypto, I would imagine the TFSA is probably not where you want to put it. But I mean, if you're buying it with the intentions of holding it for the long term, it could be a potential account you could put it in. Obviously, there's probably a much higher likelihood of, I guess you could say, risk of ruin from crypto rather than, say a blue chip dividend payer. But I do know a lot of people who put crypto inside of a tax sheltered account, and obviously these ETFs are a very good option for that. I mean, even let's say 10 years ago or even less than that, you would have had to buy cryptocurrency and you would have had to pay tax because you couldn't tax shelter it. So those ETFs do provide a pretty interesting opportunity in that regard.
Okay, let's get to your second investing tip for the TFSA, and this is to consider prioritizing this account over others, especially if you earn less than $75,000 or so in annual income. Why do you think that could be a savvy move?
So I guess first, there is a few caveats to this, like for the RRSP, which we'll go over next. I find that if there's specific situations like employer matching, so say you're contributing to an RRSP and your employer will bump that up, that can kind of have the RRSP take precedence over the TFSA, depending. But the TFSA, the reason why you invest in this account when you're under 75,000 is the RRSP is more so beneficial to higher income earners. But I'll get into that a bit more. But again, there are a few situations. The RRSP, if your employer is matching, sometimes this can offset the benefits of the TFSA. I ended up doing this when I was very young. I contributed 12% to my RRSP, and my employer contributed the remaining 6 to get up to 18%. Now, the TFSA at that time would have been much more beneficial on a surface level for me because I didn't make a lot of money, but I opted for the RRSP because of that matching. It just kind of mitigated all of that. And then the other caveat would be if you're looking to buy a home, you might find that the FHSA, sorry, that's a hard one to say, is more beneficial than a TFSA just because you're looking to buy a home in, say, the next 2 to 5 years. But let's just say you're strictly, you make under 75,000, you're strictly looking to contribute to an account to invest in. I would say the TFSA is probably the best because the tax benefits of something like the RRSP are just not there for somebody who makes that little of amount. And, with an RRSP, you're kind of I don't want to say you're locking that money in, but it's more so a retirement vehicle, where a TFSA is just kind of a liquid, tax-free investing account. You can pull money in and out, things like that.
Yeah, and we actually have a chart up on screen there that was showing how much more of a benefit you get as you move up the income scale when you use an RRSP. The tax savings can be quite significant. So yeah, to your point, you aren't getting the maximum benefit from the RRSP at lower marginal tax rates. But that's a great point that you make about the employer match because, nobody wants to turn down quote unquote free money, right? So that's a good mitigating circumstance. Generally speaking, do you think that there's like a quote unquote optimal account contribution order for someone who's earning 75K or less? Or I know it's very situation specific, but like in general, is there a rule of thumb that you can offer?
Yeah, like I said, if you're let's just say you're strictly looking to invest, I would argue you would go TFSA, then FHSA, and then RRSP. And the reasoning for this is there's a bit of situation with the FHSA, which we'll talk about later. But I guess you could say the RESP too is very case dependent. Like you might find it in that situation, you want to contribute to your kid's education first. Ultimately, it kind of overrides that, but that's generally a good order if you're looking to just solely invest. But if you have any sort of particular situation, again, that employer matching, you want to buy a home, you want to invest for your kid's education, like one account can pretty easily take precedence over the other.
Mm-hmm. Okay, well, you mentioned FHSA. Let's get over to that account now and get into your first tip here. But before we do that, can you just give us, again, a quick refresher on how the FHSA works at a high level?
Yeah, so if we looked at the TFSA, we don't get a tax credit going in, but we don't pay tax coming out. Like the FHSA is kind of it's a mold of the RRSP and the TFSA together. So with the FHSA, you get a tax credit when you deposit money, like the RRSP, which we'll go over next. But you also don't pay tax on the withdrawals, assuming that it's used for a home. So you could argue that it's kind of, I would argue like on the surface level, it is the best registered account, like tax sheltered account in the country, just because of that, credit in, no tax out. But it's very specific, obviously. There are issues with it. You have to be able, you generally you want to be able to buy a home. That's the only reason why you would use this. But it has a $8,000 a year contribution limit. And the one key difference between this account and the TFSA is the TFSA, you accumulate room no matter what. With the FHSA, you have to have the account open. So even if you are not considering buying a home right now, just open up the account, because if you don't do it and then 2 years down the line you want to buy a home, if you haven't opened up this account, you won't accumulate that room.
Yeah, that's a really good point about the FHSA, because, and that's one of the tips to do that I've heard too. Like just get it open, get that room building, so that down the line you can use it when you have. You don't have to wait for it to catch up to your goals, basically. That said, an interesting tip that I know that you have here is that it can make sense to contribute to an FHSA even if you don't intend to buy a home in the near term. Walk us through how that could make sense for an investor.
Yeah, so that was kind of what I was talking about when we went back and I said like the FHSA might be more beneficial than the RRSP because, for somebody earning less, because you can contribute to this account and invest in this account with no intentions of buying a home, because it can stay open for 15 years. Or I believe it's 71. Like if you have to turn your RSP into an RRIF, I believe they make you close this account. But if you have no intentions of buying a home, they will let you kind of put the FHSA contributions into your RRSP. So this doesn't actually take up any of your RRSP room. It's just kind of an added bonus room that you can put in there. This would have been a very beneficial account back when I was, 20. I wish I had it. I had to use the first-time home buyers through my RSP, which is not as good of an account as this, situation for buying a home. This, it's one of the better accounts in my opinion.
Yeah, it's almost like you can get extra RRSP room that you can just like roll right over even if you don't want to buy a home. It's a pretty sweet benefit. I too am bemoaning the fact that this account did not exist when I was buying a home. But hey, whatever, I got a home, I found a place, it's all good, it's all good. In any case, do you think that if somebody were to use it like that, essentially like they're trying to use the FHSA as a way to just get extra RRSP room down the line, are there certain types of investments that they might want to consider for it that they wouldn't necessarily if they were going to use it for a home and they were going to buy a home in, a few years or something like that?
Yeah, I mean, if you're opening this account with the intentions of just kind of investing and eventually rolling it into your RRSP, I just can't see why you wouldn't just kind of go with an all-in-one fund like an ETF, or whether or not you wanted to buy individual stocks, something like that. That's completely up to you. But generally, when your time horizon is longer, you can kind of invest in longer-term options. Whereas, like, let's say you're opening this account with the intentions of buying a home in the next, say, 5 years, you might, kind of be more aggressive at the start of it. But as you kind of tail off to the point where, say, you need that down payment, you might start to become more conservative, because if that's the case, you might find a situation where you go to buy a home and the market tanks by 30% and you have, say, 100% stocks in that account, and you're sitting on a 30% less down payment for your home. So if you're just looking to do it to roll it into an RRSP, I would just invest like you normally invest. Whereas if you're looking to utilize it to buy a home, I think you kind of have to change your strategy as you get closer to that, actual purchase of the home.
Yeah, I know it's been a struggle for a lot of young investors, because on the one hand, it's almost like you have to reach for higher yielding, higher returning investments just to keep pace with the home price increases over the last few years. The market's shifting a little bit now. Maybe, that isn't quite as much in the equation, but that's a good point about keeping the time frame in mind of when you want to use this money. Let's get to your second tip for the FHSA, and that's to consider deferring the tax deductions that you earn from contributing to the account into future years. When might that make sense for an investor to do?
Yeah, so if you're optimally not earning much, and I guess when we go over the RRSP, it'll probably make a little bit more sense, but ultimately, the more you earn, the more tax you pay, and contributions to the FHSA, like I said, are kind of, it reduces your taxable income. So the more you earn, the more you're ultimately going to get back, all else equal. Obviously, you could owe money in other areas, but if your income is lower, like let's say you just open this account up and you're a part-time student, you might be, let's just say, in a 15% tax bracket, and I'm kind of just making up numbers here. So on $1,000 contribution, you would get $150 in credit back to you. Whereas if you're a higher income earner, you might be in a 30% tax bracket. So on that $1,000 contribution, you'll get $300. So you can see when your income gets higher, you will ultimately benefit more. So if you're a part-time student and like let's say in 3 or 4 years, you're going to be working full-time and making, you could, double, triple the wage. It does make sense to contribute to this account, but actually defer when you actually claim that tax deduction.
Yeah, now obviously there's a little bit of like guesswork that involved in like when are the future earning years coming, right? Do you have any sort of like, I don't know, rules of thumb or anything like that can help an investor, figure out when to defer and when to exercise?
Yeah, that's difficult. I guess the student situation would probably be the easiest because I don't want to say it's guaranteed, but it's like if you have a part-time job and you're in university, there's a very, very high likelihood that, in the next half decade or whenever you get out of school, you're going to be earning more. I guess the trickier situation would be if you have been working for a while, let's say your income is volatile, I can think of somebody from here in Alberta. Let's just say they work in the oil and gas sector. Some years they might make, 100,000. Some years they might make 150. Some years they might not work at all. So, in that situation, it gets a lot more complicated. The more predictable your income, I guess, the more beneficial this would be. But I can't really say a tip because it just depends on your overall situation.
Yeah, I know like a lot of like gig workers or freelancers and stuff, the guesswork goes to a next level of difficulty, but you try your best and just keep it in your back pocket that this could be a good strategy. Appreciate you sharing all these tips so far, Dan. We got a lot more to get to, but I want to take a little bit of a pause in the action because I got a little bit of fun. I got a trivia question for our audience related to these registered accounts we're talking about. And Dan, I want you to weigh in too. Here's the trivia question. It goes like this. What was the median amount of money that Canadians contributed to their RRSP in 2023? This is the latest year that we have data for, according to the data collected by Statistics Canada. So is it A, $2,100, B, $4,000, C, $5,400, or D, $6,100? Dan, you want to venture a guess?
If I were to guess, I would go A.
A, $2,100?
Probably because, yeah. I just think like a lot of people... And it sounds bad to say, but a lot of people are just generally not that good at saving money. And then the RRSP is also an account that really only benefits, higher income earners. So I would tend to go to the low end here.
Yeah, I think the TFSA also can kind of steal a little bit of the thunder of the RRSP too for some people, right? So let's reveal the answer. Let's see what it actually is. The actual answer to the question is, in fact, B. It's $4,000. That was the median contribution. It actually peaked at $5,000 among Canadians between the ages of 55 to 74. No surprise there because they are, generally speaking, in the best position to make larger contributions. But yeah, I was a little bit surprised at this one too. I didn't think it was going to be that high, but maybe it is, and then TFSA and now FHSA too, stealing some of the contribution dollars. There's only so many to go around, right?
Yeah. Yeah. And at least I would have been really surprised if it was D, like the higher end. But yeah, I think there's more beneficial accounts. I would have been curious what this number would have been pre TFSA and FHSA. But yeah, it's not surprising to see it on the lower end just because, again, the account is so specific, useful to, a smaller portion rather than the TFSA.
Mm-hmm. Well, perhaps it's a New Year's resolution for some folks out there. Use the RRSP a little bit more if you have the capacity to do so, and it does make sense. Something to shoot for in 2026. All right, let's move on to the RRSP since we were just talking about it. Again, can you give us just a quick refresher on how this account works?
So yeah, the RRSP, we had the TFSA, which is no credit in, tax-free out. FHSA is credit in, tax-free out. The RRSP is credit in, but you pay tax on the withdrawals. So you're maxed out at 18% of your previous year's income, and there's actually a dollar amount too. You have it there. So 33,810 of your, that's your max, regardless. If you make way more than this, but generally it's 18% of your annual income, and then anything inside of that account is tax deferred. So let's say you contribute to your RRSP, you buy a stock, you sell it 5 years later for a capital gain, and let's say you've earned a whole bunch of dividends as well. All of that is tax-free. Eventually, when you pull that money out, you will pay income tax on it. But It's different than, say, a taxable account, because in a taxable account, if you sold that stock, you'd pay a capital gain or a capital loss in that regard. And then, the dividends would be taxed in the year you received them. So it's pretty much an account that the government lets you invest in throughout your working career. And then you just have to pay tax when you are retired pulling it out. And I mean, the main goal here with the RRSP is to put money into your RRSP when you are in a higher tax bracket than you would be when you're retired. So just very quick numbers. You make $100,000, you're in a 30% tax bracket. Again, I'm just kind of making these up. In theory, you would get, if you contributed $10,000 to an RRSP, you would get $3,000 back. And let's say in retirement, you pull that $10,000 out and you're in a 15% tax bracket, you would only have to pay $1,500 in taxes. So you can see the benefit there. Obviously, this account has a whole bunch of different nuances to it. For example, like pensions can really impact, RSP contributions, like what you pay, things like that. So this is one that's very, very specific. If you're looking for information, you have to really have somebody understand your situation. But yeah, that's the account in a nutshell.
Yeah, it's definitely tax deferred is the sort of the key to highlight there with this account, as opposed to tax free with TFSA, of course. Let's get into your tip. Your first tip for the RRSP. This one is to hold U.S. domiciled investment products. In other words, whether it's a stock, a mutual fund, an ETF, or what have you, that is for tax purposes based in the United States. To hold these products in an RRSP, as opposed to the others, to avoid the withholding tax that you might owe on foreign dividend income. That was a word salad here. Can you maybe explain how does a withholding tax work at a high level, and how can the RRSP help investors avoid paying it?
Yeah, so pretty much if you own a U.S. dividend payer, let's say, for example, the IRS kind of wants, their piece of the pie before the money leaves the country. So generally they would charge a withholding tax on the dividend of, the company paying it, or the dividend portion of an ETF that's paying it. So ETFs are a little bit different because they're distributions can be a wide variety of things, but you're paying, tax on that dividend of, let's say, a U.S. company. There is a tax treaty from Canada and the United States that kind of recognizes the LIRA and the RRSP as retirement accounts. So they do void this withholding tax. You won't pay it if you own U.S. domiciled investments. So there's one very important thing you do need to understand about this, however, is just because you own U.S. stocks or U.S. ETFs does not make it a U.S. domiciled investment. And I'll give a quick example of that. Let's say something like VFV, which is a Canadian listed S&P 500 ETF. You would think because it's the S&P 500, if you put this in your RRSP, you would not pay a withholding tax, but it is a Canadian domiciled fund. So you actually do get charged the withholding tax on that type of fund. So if you own something like VOO, which is the US domiciled version of this, that is when it would be kind of, you wouldn't pay it. And there's also a lot of situations with Canadian companies that a lot of people get confused with as well. So I think of one right off the top of my head would be Waste Connections. So this is a Canadian headquartered company that operates, 90% operations in the US. It pays its dividend in US dollars. So a lot of people think that they might pay the withholding tax on something like that, but it's Canadian domiciled, so you don't. Whereas, and then we have something like Ovintiv, which for a lot of people in the energy sector, that would have been Encana before they moved to the US. So they're a Canadian company, but because they moved their headquarters from Calgary to, I believe it was Colorado, they're US domiciled, so you would pay the withholding tax on that distribution. So it's a lot to do with where the fund or the stock is located, not necessarily where they operate or not necessarily the currency they trade in.
Mm-hmm. And those are some great examples that you shared to help kind of illustrate all the nuance that can be here.
Yeah.
With this one, I know a lot of investors struggle with, well, I want to use the TFSA, but obviously I don't want to pay this withholding tax. Like, should I, put my U.S. domiciled investment in the RRSP just to get away from that? Like, generally speaking, do you think it's worth stressing over that, or is it kind of just like a nice to have? If you were going to use the RRSP anyway, it's like a bonus, or is it something that's worth like going out of your way to take advantage of?
Yeah, and I think this is like one of the biggest mistakes that investors make, primarily new investors. So they'll hear lots that you can't own U.S. stocks in a TFSA. It's bad because you'll pay that withholding tax. So what they'll end up doing is just not buying US stocks at all. So let's just say, for example, all your accounts are filled up and you're able to kind of structure your portfolio to be able to mitigate taxes. In that situation, then yeah, you don't want to own your US dividend payers or US dividend paying ETFs in your TFSA. Just kind of structure it so that you can hold them in the RRSP to mitigate that tax. But let's just say you're brand new and the TFSA is the most beneficial account for you, and that's the only account you're contributing to. A lot of people will get into the situation where they say, I can't own US stocks in this account, it's bad. So they'll just buy, 100% Canadian stocks in their TFSA, and they end up with a portfolio that's, 100% Canadian. And, they don't have any exposure to the US, and they kind of just end up designing like a suboptimal portfolio. Like, what I would say is utilize this when it makes sense to, like, when your accounts are maxed and you can kind of structure it that way. But like if the TFSA was my only investing vehicle, I'm not really worried about paying a 15% withholding tax just to own US stocks in there. I owned, like when I started out and it was just my TFSA, I owned plenty of US stocks. I think to not buy those types of holdings, like US exposure, just to save a 15% tax is, I don't think it's the best.
Yeah, and point of clarification too, or emphasis, I should say, is it's 15% on the dividend income, right? It's not just the stocks in general. I think people sometimes get tripped up over that too. Time is getting away from us here, Dan, but let's just get to your second RRSP investing tip real quick. And this is to double down on RRSP contributions in higher earning years to maximize that tax benefit. We talked about it a little bit earlier, but just underscore it for us again. How can this really benefit investors?
Yeah, so obviously the higher your taxable income, the more beneficial it is to put money into an RRSP. I did this a lot because I used to work, this would have been 7-8 years ago though, I worked in the oil field, and some years I would earn a lot, some years I wouldn't earn that much, and I would kind of use those higher income years to kind of double down and contribute more to my RRSP. In the years that I didn't make that much, I wouldn't contribute at all, just knowing that, eventually in the boom and bust industry, there would be years where I would earn a lot. So in that instance, it can really amplify your return from your tax credit, obviously. And yeah, it's pretty simple. The more you earn, the more tax you pay. So if you can kind of align that to contribute more during your higher income years, you'll ultimately get more back, which amplifies the benefit when you're paying less in retirement.
Yeah, and of course, the important thing too for investors to remember is that when you get that tax refund from the RRSP contributions, reinvest that too. Otherwise, you're not getting the full benefit of this account. I know a lot of people get tempted to buy themselves like some kind of toy or a vacation or something like that. Not the best move, obviously, from an investing and finance point of view. Thank you so much, Dan, for sharing those tips. We got a lot more to get to, but a quick question for our viewers. Are you enjoying the show so far? Well, then make sure you follow TD Direct Investing on YouTube, Instagram, and Facebook to get a sneak peek at upcoming episodes and a ton of other content designed to help build your investing knowledge. You got the QR codes on the screen there. Make sure to check us out. Our live Q&A is coming up in just a few minutes, so make sure you get your questions in for Dan if you haven't already. But first, I want to bring in my colleague, Caitlin Cormier. She's going to show us some of the tools on WebBroker that can help investors manage these registered accounts, TFSA, RRSP, and FHSA. I'm getting really good at saying all those acronyms, by the way. Caitlin, welcome to the program. Happy 2026 to you. Glad to have you back on the show.
Yeah, same to you. I'm going to leave those acronyms to you. I'm not going to trip over them yet. It's still early in the year. I don't need to make that fumble yet.
I was practicing in the mirror more than I'd like to admit. But in any case, let's get down to it. Let's say an investor wants to contribute to multiple registered accounts like that we've been talking about. That can obviously get really cumbersome, managing all these deposits separately. Is there anything they can do to just make their life easier?
Yeah, absolutely. there's lots of different things we're saving for, lots of different places you want to put money. And my New Year's resolution is keep things simple. So I'm going to show you how to make those contributions to all the different accounts without having to manually do it yourself. So let's hop right into WebBroker, and we're going to go under accounts, and we're going to click transfer. So just any of these top 3 are fine to click on. It's going to bring us to this screen. So depending on whether it's from a TD bank account, we're making these contributions from outside TD. So whichever one it is, we're going to go ahead and select, choose which account it's coming from. So this would be the bank account. Then you're going to select, of course, the account it's going to. So whether it's that TFSA or the RRSP or the FHSA. Okay, I did it. Whichever account it is you're making that contribution to, put your amount in. And then, of course, make sure to click this Make a Recurring Transfer button. Same thing with outside. You just have to click the recurring button here, and you can go through that same process of going through and saying, you know, whatever the frequency is, when you'd like it to start, the amount. In this case, of course, if it's coming from outside of TD, you need to provide some banking information so we can pull it from the right spot. But very straightforward way, put a little bit of legwork in up front, and then you have all those contributions happening automatically. So you can just sort of rest easy and know that your money's getting contributed to the accounts.
Yeah, it's a good way to work towards those New Year's resolutions that you might have for your finances. Set it and forget it almost, and just put that money to work as it comes into the accounts. That said, one of the things Dan and I were talking about earlier too was avoiding speculative investments in an account like a TFSA. How can investors get a sense of how risky your speculative investment might be when they're looking at on WebBroker to kind of help them determine whether, you know, one account is appropriate for it or another?
Yeah, absolutely. So there's a couple different measures. It depends what you're looking at as far as investments, what's available. If you're more of a stock investor, you're buying kind of those individual securities, then you might want to look at beta. This is essentially measuring the volatility of that particular investment versus whichever index it's most compared to. So for example, the S&P 500. So how much it's moving with the index, or if it's moving outside of the index, meaning more volatile than the index. If you're doing ETFs and funds, those sorts of things, maybe you're looking at standard deviation, which is showing you basically how much the fund might go up or down from its kind of average price. So let's just go ahead and hop back into WebBroker and look at where we can find that information. So I'm going to click on research. I'm going to click on stocks. It's just going to pull up a random stock here for me. And then as I scroll down on the right-hand side, we're seeing beta here. And this particular stock is a beta of 1.09. So that means it moves slightly more than the benchmark does. So 1 would mean it moves kind of exactly with the benchmark. 1.09 means it moves 0.09 more than the benchmark, just to kind of give you an idea there. And then I'm just going to pull up a fund that I just heard mentioned when we were talking about those pesky dividends inside and outside of Canada and TFSAs and all that. What we'll do here is we'll actually click on performance and risk. And here we have the beta. Of course, this is linked exactly with the S&P 500, so we should see it move almost exactly at 1 for the beta. But the standard deviation is going to show us that variance in price, so how much it should move kind of outside of that average price for the investment. So looking at these sorts of things can be a way to, you know, understand how much a stock or an ETF might move up or down. And of course, we can always look at history and charts and that sort of thing as well to get a bit of an idea of what we can expect. Of course, past is no indication of the future, but it's all we have to look at.
Yeah, good reference point, good place to get the ball rolling on that sort of research and get your head around the speculative nature or not of the investment that you're considering. Caitlin, really appreciate you joining the show as always, and we'll see you next week as well. That was TD Direct Investing's Senior Client Education Instructor, Caitlin Cormier. Okay, Dan, let's open the floor. We're going to take questions from some of our viewers. Are you ready to hear what they want to know more about?
Yeah, let's do it.
All right, let's dive in. Let's pull up our first question. This one coming to us from Sid. Sid says, with my TFSA and RRSP fully utilized and my home paid for, congratulations to you, Sid, what additional wealth building strategies are available to me? Dan, what do you think?
I mean, once you get to this like situation, I mean, you're probably, you know, having to open up a taxable brokerage account, which, I mean, a lot of people get frustrated with because they have to pay tax in these accounts, but it's also, you know, a situation where you're probably doing quite well. You have all your registered accounts maxed out. And yeah, you just kind of have to open up a cash account or a margin account. They sometimes call it, unless you're speaking on like other avenues outside of stocks, but I'm not necessarily sure, you know, what the question is asking fully.
Yeah, I mean, that would probably be a little bit outside the scope of the conversation, but that's a good point. Yeah, the non-registered accounts, cash accounts, margin accounts, like those are, yeah, probably the next go-to. Although, Sid, you're doing something right, clearly, if you've maxed out these accounts. So bravo to you. Let's get to our next question then. This one coming to us from Leanne. Leanne's asking, can you give an example of a TFSA investment for an 18-year-old seeking decent growth with moderate risk? Now, of course, we can't give specific investment advice like, specific tickers or anything like that. But Dan, more generally, do you think that there are certain categories of investments that would kind of fit the bill of what Leanne's looking for here?
Yeah, I mean, in today's like ETF world, they have a lot of ETFs that you can kind of buy depending on your overall risk tolerance. So in that regard, like even 10 or 15 years ago, you really couldn't find an ETF that gives you exposure to, let's say, 10,000, 11,000 different companies in a single click. So for somebody who just kind of wants to set and forget it, you could look to those. And depending on your overall risk tolerance, they have ones that are allocated differently. Like you could get some that have 100% stocks. You could get some that have 80% stocks, 20% fixed income. You could go 60-40. I believe they even have some that are 50-50. So it's a lot easier now than it was back when I started. But yeah, if you're looking for just an option like that, fairly easy. I mean, if you want to get into the individual stock route, that gets a lot more complex than I could answer in this question, because I mean, moderate risk, my definition of moderate risk is probably a lot different than yours.
Yeah, I think those asset allocation ETFs that you mentioned are definitely a good starting point to consider. And for an 18-year-old, I mean, we don't know what Leanne's child's goal is necessarily, but an 18-year-old presumably has a long time horizon, so they could probably weight heavier towards the equity end of things, maybe an 80-20 stock to bond asset allocation ETF or something like that. So food for thought, Leanne. Let's get to our next question. This one coming to us from Ryan, and actually several viewers. We got a party here. Everybody wants to know this one. I bought and live in a home purchased 5 years ago. Can I open an FHSA to buy a second home as an investment?
No, I don't believe so. This is actually a question that I don't know 100%, but I'm like 90% sure. The only way you can open up a FHSA is if you are buying your first property. I don't think you can't open one up, contribute it to it, and kind of buy it for, say, like a piece of rental income or sorry, a rental property.
Yeah, I know a lot of investors are sort of grumbling about that being the case. Although one caveat to this, to my understanding, is first home is you've owned a home within, I believe it's the last like 4 or 5 years, something like that. So if you had previously purchased a property, maybe you sold it and you haven't owned a property in that 4 or 5 years, what have you, then I believe the FHSA does become an option for you again. So a little caveat there to consider. Let's get to our next question. Let's see what we got. Raphael and also several viewers also asking this one. Is there a risk that frequent short-term trading in a TFSA could result in taxes or taxation?
Yes. So if the CRA kind of determines that you're using the TFSA more so like a business rather than a investment, account, they can tax you. I have known one person that got caught doing this, like over the entirety of me investing. But they were making, I believe it was around like 350, 400 trades in their TFSA. It was extensive. Like for somebody who buys, I think a lot of people get worried about trading too much in this account, but let's just say you're not somebody who can max the TFSA out at the start of the year in January, and say you have to make weekly contributions to max it out by the end of the year. A lot of people are thinking, oh, that's 52 trades a year. You're not going to get in trouble for doing that if you're just routine investing, like say once a week, contributing, buying. Like where it becomes difficult is you're buying and selling at a pretty high pace to the point where, yeah, it's more so you're operating a trading business rather than the investment vehicle.
Yeah, I would agree that it is exceedingly scarce that, at least to my knowledge, that this issue comes up. But it's good for people to be diligent about it, make sure that you don't cross that line. It is a very gray area. The CRA doesn't come out and say, this is the line and you can't cross it. So a little bit of guesswork involved there too. But that's a great context for us, Dan. Let's get to our next question on tap. This one coming to us from Krish. Krish wants to know, given the current geopolitical situation, what's your view on investing in US-based ETFs and stocks?
Yeah, I mean, if your time horizon is long, like I do it, but you know, I guess back when I started, like let's say 2009, like post financial crisis, there was the same fears about everything. You know, coming out of the financial crisis, like I think people have asked, you know, is XX a good time to buy stocks? Pretty much every single year. I mean, we had, say, back in April, people were asking, you know, after the tariffs, is it a good time to buy U.S. stocks? They're up a bunch. You know, during the pandemic, people are like, should we buy U.S. stocks? They're up a bunch from there. You know, when oil crashed back in 2014, people were asking, is it a good time to buy stocks? I think if your time horizon is long, it's just generally, you know, there's 100+ years of history that generally shows you that investing is good, regardless of, you know, what's going on. There's a few situations that would have been bad, I guess. I mean, you can think of, say, the .com bubble, which, you know, it wasn't very good afterwards. But I mean, generally, timing these types of things is very difficult. Any event that you think is going to be bad is generally not as bad as perceived. And yeah, I think that's just it. If your horizon for holding stocks is, say, 10, 20, 30 years, I guess, like, what does it matter what happens over the next 6 months? If the market, say, falls by 20 or 30%, all that kind of does is allows you to buy more stocks at cheaper prices, or ETFs, whatever it may be.
Yeah, it's a good point. One of my favorite charts that I always like to reference is it just looks at like the S&P 500 over a really long period of time. And along the way, you see all the terrible events and disasters and crises that happen along the way. And yet here we are still rocking at all-time highs or what have you, right? So with a long time horizon, it does afford you a lot of ability to look through a lot of the volatility. So that's a great point. Dan, I think that's all the time that we have for our Q&A, but we appreciate you fielding some of those questions. Great stuff. And of course, all the tips that you shared with us to get the new year rolling on the right foot. We really appreciate it. Thanks again for joining the show. And of course, good luck with the newborns as well. Hope all is well in the household.
Yeah, thanks for having me. It was fun.
Yeah, we'll have you back again soon for sure. And of course, to our audience, of course, we love it when you tune in. Thank you for tuning in as always. Make sure you check out next week's episode. We have financial content creator JC Sage, who started investing at just 18 years old, shares her survival guide for Gen Z investors who might be a little bit nervous to dive in like she did. It's both financially empowering and easy to follow. So make sure you check it out if you're looking to make the leap, or you know someone who is that would benefit from it. You don't want to miss this one. Great one coming up. That's all the time we have for this edition of the show. From everyone at Inside Investing, thank you so much for watching. We'll see you all next time.